Welcome to This Explainer. Today, we're going to peel back the layers of the global stock market to see exactly how those zero-commission trades actually work behind the scenes. Look, if you've ever tapped a button on your phone to buy a piece of your favorite company and thought, wait, how did that just happen for free? Well, you're in the exact right place. We're about to explore the hidden mechanisms, the massive financial players, and some of the highly debated practices that power the modern retail market. Let's get into it.
Okay, so here's our roadmap for today. We're going to start with stocks versus shares, then look at the anatomy of a trade, unpack payment for order flow, discuss the price of free, and wrap the whole thing up with global rules and faster settlements.
Let's kick things off with part 1, stocks versus shares.
So to really understand this invisible market plumbing, we kind of have to get technically precise about what's actually changing hands. Think about the whole money versus dollars analogy, right? Money is just the general concept of what you use to buy things. Dollars, on the other hand, are the specific units of measurement that tell you exactly how much money you have. And you know what? It works the exact same way in investing. Stock represents the broad concept of partial ownership in a company. You can buy it, sell it, trade it. But shares, those are the specific individual units of that ownership. So when people talk about transferring stock, what's literally changing hands in the market are the specific shares of that company. And each share holds the exact same value as the next one, which is determined entirely by what the market thinks the company is worth.
But here's something wild. Direct, named ownership is actually surprisingly rare. According to Pew Research, only 21% of American families hold shares directly in their own name. Just 21%. That means less than a quarter of families are actually logging into a brokerage account, buying individual shares, and holding them directly. The vast majority of investors, well, they own their shares indirectly, usually through mutual funds, exchange-traded funds, or pension funds. In those cases, the fund itself is the legal shareholder. They make the voting decisions while you just own a little slice of the fund itself.
All right, moving on to part 2, the anatomy of a trade. So you might imagine that when you hit buy on your favorite trading app, your order gets beamed directly to some busy, chaotic floor at the New York Stock Exchange, right? Just waiting to be matched with a seller? Well, actually, scratch that. That's not usually what happens at all. Instead, your broker routes your order to a massive financial firm known as a wholesaler or market maker. We're talking about heavy hitters here, firms like Citadel Securities, Virtue Financial, or Susquehanna. These firms actually step in and execute your order using their own massive inventory of stocks. This process is called internalization. They aren't sending your order out to a public exchange to find a match. They are literally taking the other side of your trade themselves. But wait a second. That begs the multi-billion-dollar question, doesn't it? If the app isn't charging you a commission, how exactly is your broker making any money?
Well, that brings us to part 3, payment for order flow.
The answer to that multi-billion-dollar question is something called payment for order flow, or POFF. And here is exactly how that invisible plumbing turns into cash. When a market maker fills your order from their own inventory, they profit from what's called the spread. Now, the spread is just that tiny, microscopic difference between the purchase price and the sale price of a share. Because everyday retail orders are generally considered highly profitable and way less risky for these market makers, these firms will actually compete for the right to execute your trade. And to win that right, the market maker rebates a small portion of their profit from the spread right back to your broker. That rebate, that's the payment for order flow. Your broker is literally getting paid for routing your business to them.
To really grasp just how incredibly lucrative the word free actually is, consider Robinhood's 2021 transaction revenues. They pulled in a whopping $1.4 billion, which made up over 77% of their total net revenue for the year. And they did this just by monetizing the act of routing your order flow. And hey, it's not just stocks either. The breakdown is fascinating. 49% of that came from options, 30% from crypto assets, and 21% from standard equities. Zooming out across the entire industry, stockbrokers received a staggering $2.5 billion in PFOF in 2020 alone. So yeah, free trades, as it turns out, are a phenomenally profitable business model.
Which leads us perfectly into part 4, the price of free. By fundamentally restructuring how these firms make money, shifting from charging clients up front to monetizing the act of routing trades, payment for order flow has sparked a massive industry-wide controversy. Critics of this system absolutely do not mince words here. They flatly describe it as a kickback, and they raise some serious concerns about conflicts of interest. The argument is pretty straightforward. If your broker is getting paid by a third party to route your trades, they are financially incentivized to send your order to whoever offers the highest rebate.
And that might not necessarily be the market maker offering you, the retail customer, the best possible execution price. This exact issue was actually a major focal point during a 2014 U.S. Senate investigation, which scrutinized whether brokers were prioritizing their own revenue over their clients' best interests. But, on the flip side, academic researchers and industry defenders strongly push back against that narrative. They argue that PFO actually increases market liquidity and reduces those bid-ask spreads we talked about. For instance, a 2022 study by researchers from UC Irvine, UC Davis, and UC Berkeley found literally no evidence that PFO harms price execution for retail stock trades. In fact, they found that market makers often give better pricing than the figures quoted on public stock exchanges. What that means is retail traders can actually get slightly more per share when selling and pay slightly less when buying. This price improvement, combined with the total elimination of commission fees, is championed by defenders as a massive win for the everyday investor.
Now, this whole academic and regulatory debate absolutely exploded into the mainstream consciousness during the GameStop short squeeze and all those meme stock events that followed. The sheer volume of retail trading brought this massive spotlight onto the practice of brokers selling bulk retail orders to just a handful of huge market makers. This intense scrutiny prompted officials, like SEC Chair Gary Gensler, to openly question the inherent conflicts of the practice. It was such a heated topic that it even led platforms like Public.com to completely abandon payment for order flow as a business model, just to distance themselves from the controversy entirely.
Okay, let's wrap things up with Part 5, Global Rules and Faster Settlements.
As we zoom out to the macroeconomic level, it becomes super clear that the United States is actually quite unique in how it regulates this invisible plumbing. While the U.S. allows payment for order flow as long as firms follow strict transparency rules like SEC Rule 606A, which makes brokers publicly report their routing practices every quarter, just consider the rest of the world. In Canada, PFO is straight up banned on domestic listed securities, meaning brokers there generally still charge commissions. It's totally banned in Australia too. The UK's Financial Conduct Authority effectively prohibits it, saying it's completely incompatible with best execution rules. And the European Union, they're currently implementing a formal ban that's going to be fully rolled out by 2026. But it's not just about how trades are routed and paid for. Regulators globally are also taking a hard look at broader market efficiencies, specifically focusing on just how fast this plumbing operates. A major focal point right now is something called T+1. That stands for the shortening of standard settlement cycles to just one single day after a trade is executed. Currently, the European Securities and Markets Authority, or ESMA, is holding public hearings to evaluate how this rapid settlement could further modernize the whole system, reduce risk, and keep the global market flowing as efficiently as humanly possible. So, we've seen how this simple definition of a share translates into this incredibly complex web of market makers, internalized trades, and microscopic rebates that power the apps right on our phones. It is honestly an incredible feat of financial engineering, and it's one that has completely eliminated entry fees for millions of people. But as you look at your portfolio today, I want to leave you with this one thought. In a world of free trades, rapid settlements, and invisible plumbing that constantly monetizes your order flow, are you the customer or are you the product?